Okay, so the purpose of this short video is to just walk you through the fundamental aspects of the statement of cash flows, and then on subsequent videos we'll go through a few examples and create a statement of cash flows using the direct method and the indirect method. So why does US GAAP require the separate disclosure of cash flows? Plain and simply, it's to provide more useful information. And I want to kind of take a step back, and when we talk about useful information, we can think in terms of both content, but also the transparency of the disclosure. You can get current cash flows through other means. In other words, you can kind of sort of predict the cash using the balance sheet and the income statement, but the transparent disclosure of the cash flows allows the information to be more predictive, or to provide predictive information about future cash flows. And current cash flows are actually more predictive than accruals when it comes to future cash flows. And so I just wanted to highlight the point that while the information in the statement of cash flows can be found other places by piecing together information, the statement of cash flows provides that information in a very transparent way. So what information does the statement of cash flows provide? For one, users can better predict the firm's ability to generate future cash flows. They can better predict the firm's ability to pay dividends and meet obligations. They can better understand the reasons that net income and operating cash flows might be different. And of course, it gives them insight into non-cash investing and financing activities. There are three types of cash flows: operating, investing, and financing. Operating are day-to-day operations. Investing is cash generated or spent buying and selling non-current assets. And financing is cash generated or spent from issuing or retiring the firm's debt and equity. That does include paying dividends. It does not include interest payments. What is a cash use versus a cash source? A cash use is a cash outflow. In other words, you're using cash to pay for something. A cash source is a cash inflow, so you're receiving cash for some reason. What's the difference between the direct and indirect method? The difference really is only in the operating section of the statement of cash flows. The direct method will analyze specific and separate operating activities, while the indirect method will aggregate all operating activities together into one flow. Investing and financing sections are the same for both methods. So what does FASB require? FASB requires the indirect method, but also highly encourages firms to report using the direct method.